Welcome back to episode 2 of the $100 to $10,000 series. The reason I started this series is because schools don't teach us the most important things about adulting, finance, and investing. And there are so much information out there, too much information in fact, as Barry Schwartz said in his book, as the number of funds in a 401k plan offered to employees go up, the likelihood that they will choose a fund, any fund, goes down. For every 10 funds added to the array of options, the rate of participation drops 2%. And that's the reason why I am only investing in one investment in this series. I want to show that investing doesn't have to be hours of research every day because that kind of dedication is not for everyone. And over time, I hope to show you guys that you can be a profitable investor even with a simple plan. And I hope to encourage everyone to start taking care of their finances and let your money work for you in growing your wealth. Last episode, I made my first deposit of $100 and it's been doing well for the week. We are up 3.77%. But short-term performance doesn't really mean much because these numbers will go up and down. We are investing every month with a long view of growth. There will be inevitable fluctuations in the stock market, and that is not something that we can control. What we can control is what we do with our money. There is an analogy of the stock market being similar to walking a dog. When you're walking a dog, it may get distracted by loud noises and sudden distractions and may stray from the path that you, the walker, is walking. In this analogy, the stock market is the dog and the walker is the economy. The stock market usually follows along the path the economy takes, but it is going to stray when there are loud noises or big news items that are happening. But looking from far away, in the long-term view, the dog and the walker end up at the same spot when looking at the big picture. We see this when we look at the past. In the last 50 years, the US economy averaged 6.4% growth each year, while the S&P 500 increased 6.6%. So no matter what happens to the stock market and what makes headlines, I will continue to deposit $100 every month to this account until it grows to $10,000. Now, since I purchased $100 worth of the Vanguard ETF, Vanguard has given me the prospectus of the fund, which is a legal document that discloses information such as fees, risks, and performance related to the ETF. So today, I thought I would go over some main ideas in the prospectus and their annual report. So on the first page of the document, we see the objective of this fund. The fund seeks to track the performance of a benchmark index that measures the investment return of large cap stocks. And the benchmark index that is mentioned here is of course the S&P 500 index. And we see the breakdown of all the fees associated with this ETF. There are no transaction fees that are incurred from buying or selling, but if you are using a broker that charges these fees, they will apply. Since I am using M1 Finance, there are no transaction fees on purchases or sales or in reinvesting dividends of stocks, which is great because no one likes extra fees. And management fees are 0.02%, and other expenses make up 0.01% for a total of 0.03% of operating expenses. This means if you invest $10,000 in 1 year, $3 of that 10,000 will be used in these operating expenses. Then we are shown the annual total returns between the years 2011 through 2019. The last 10 years have been really good for the general market as it's only seen negative returns in 2018. The average annual return for this particular ETF is 14.72%. Now that may not seem like a whole lot, but let's say you invested $100 every month, every year, like we're planning to do with this series, and let's see how much your account will be worth. So initial investment is zero. Monthly contribution will be $100 every month. Length of time, 10 years. Interest rate, the average of 14.72%. And the interest will compound annually. And then let's calculate. $24,000. After investing $100 every month, you would have deposited $12,000 and you would have gotten $24,000. And that's not even including the dividends that are paid to you every 3 months in March, June, September, and December. So this is what I mean by making your money do the work. There aren't a whole lot of other places you can invest in where you put in $12,000 and get basically double the amount. Of course, we have been in a bull market the past decade, but we see the same pattern over and over again in the long term. There will be sudden dips in the market like we are seeing these days, and a rebound that eventually overcomes losses from the bad times. Going over to the annual report, we see how our funds are allocated. Information technology makes up the biggest segment at 23.2%, which are companies that produce hardware, software, semiconductor equipment, or internet related services. Followed by healthcare at 14.2%, which include the likes of drug companies, medical device manufacturers, or healthcare companies. Financials, made up of mostly banks or holding companies, came in at 12.9%. The communication services at 10.4%, consumer discretionary at 9.8%, industrials at 9.1%, consumer staples at 7.2%, energy at 4.3%, utilities at 3.3%, real estate at 2.9%, and materials at 2.7%. And scrolling down more, we see exactly how many shares of each company is held and how much the shares were worth at the end of the year. The largest holding in terms of value in the communication services sector was the social media company, Facebook, with 48 million shares valued at almost $10 billion, followed by Google's parent company, Alphabet, and AT&T. In the consumer discretionary sector, which is the sector that sells products that are non-essential, like automobiles, apparel, entertainment, the largest holding in terms of value was Amazon, coming in at 8.3 billion shares, valued at over $15 billion, followed by the largest home improvement retailer in the US, Home Depot, and the world-famous McDonald's. In the consumer staples sector, the largest holding was Procter& Gamble, which I analyzed in my last video, and if you guys haven't seen it already, make sure you do check it out. After P&G were the two soft drink giants, Coke and Pepsi. Next is the energy sectors with the two largest oil and gas corporations in America, ExxonMobil, followed by Chevron. An interesting fact about Exxon was that it was the largest publicly traded company in 2007, valued at over $500 billion. In the financials, JP Morgan Chase took the top spot, followed by Warren Buffett's Berkshire Hathaway. This was interesting to see here because Berkshire also owns shares of Vanguard's ETF, so both funds are invested in each other. In healthcare, the multinational group Johnson & Johnson made the top of the list, followed by the healthcare company, United Health Group. I will go in depth on some of these companies in the future videos, so make sure you guys hit the subscribe button and turn on the notification bell so you know when I release my next video. Now let's go over some news. New job loss claims have gone down another week as 3.2 million Americans filed for unemployment this week, showing a slowing sign in the growth of unemployment rates. And as many people are staying home due to lockdown restrictions, ride-sharing businesses of Uber and Lyft have been devastated as rides went down 75% for Lyft and 80% for Uber in April. To save costs, Uber reportedly cut about 14% of its workforce, and Lyft cut 982 jobs and furloughed almost 300 employees and reduced pay for exempt employees. But both stocks went up as Lyft reported a revenue of $955 million, which grew 23% from the past year's $776 million. The company was able to do this by reducing capital expenditure or investments that are made into the company, which was reduced by $250 million, as well as turning off rider coupons and limiting the number of new drivers. Even with its reduction in costs, though, the company hasn't been making a profit. It was able to cut its net loss from $1.1 billion in Q1 of 2019 to a loss of $398.1 million in 2020. And the co-founder of Lyft, Logan Green, said, quote, "While the COVID-19 pandemic poses a formidable challenge to our business, we are prepared to weather this crisis. We are responding to the pandemic with an aggressive cost reduction plan that will give us an even leaner expense structure and allow us to emerge stronger. Our competitive resilience and commitment to our culture and values will put Lyft in the best position to deliver on our mission of improving people's lives with the world's best transportation." Uber also showed confidence with management expecting the company making a profit in a matter of months, not years. Disney also announced their earnings, and former CEO and current chairman, Bob Iger, announced that while the business has been one of the companies that was hard hit by the pandemic, he believes the company will be able to get through this challenging period and recover successfully. Adjusted earnings per share fell from $1.61 to 60 cents, primarily due to the closings of domestic parks, hotels, cruise lines, retail stores, and halted film and TV productions. And the company's income for the quarter is expected to be affected by as much as $1.4 billion, with most of its losses coming from its parks, experiences, and product segment. And so the company announced that it will not be paying its semi-annual dividend, which saves the company about $1.6 billion. On the bright side of things, Disney Plus has successfully launched in Western Europe and India, with global subscriber counts surpassing 50 million in early April. That beat the company's own expectations of reaching 60 to 90 million subscribers in 5 years. And among businesses that have been hardest hit by the virus are retail stores. And the first victim of the outbreak is J.Crew, which declared Chapter 11 bankruptcy this week. Chapter 11 bankruptcy is often used to reorganize a business while it's still operating. The business has to come up with a good plan on how to continue operating the company while paying off its debts. And both the court and the lenders must approve of the plan proposed by the business. Other retail giants like Nordstrom are preparing to file for bankruptcies of their own as they struggle to pay off their debts, with the majority of their doors closed shut. Retailers have been struggling as more and more shoppers have moved to the online platforms like Amazon and Shopify in place of visiting stores in person. Even before the pandemic wreaked havoc on the world, retail giants like Nordstrom, Kohl's, JCPenney have reverted their gains to pre-2010 levels, while the S&P 500 recorded all-time highs. Also, the FDA has approved the use of the first COVID-19 antigen test. An antigen test differs from an antibody test in that it tests if the person is infected by the virus, whereas an antibody test checks to see if the person has already got the virus and beaten it once before. What makes antigen tests important is that antigens can be detected almost immediately after infection, so the test can tell much sooner if the person has the virus or not. Hopefully, these testing kits will be distributed as fast as possible, and we can help to bring down the curve. That's gonna do it for me for this episode. Thank you guys for watching, and don't forget to like and subscribe, and I'll see you guys on the next one.